Expectations that US plans for global reciprocal tariffs would not come into effect until April has given hope a trade war could be avoided. After 3 straight weeks of losses, both Brent and WTI are heading for a gain of around 1% this week. Homayoun Falakshahi is Senior Oil Analyst at Kpler. Homayoun, are the markets getting a little bit too excited by this delay to the tariffs?
Yeah, I think so. It's not the first time that the market reacts to news about tariffs. One day it's up, one day it's down, based on what's happening. Ultimately, we think the tariffs from the Trump administration are mostly a negotiating tool, especially with countries that are close to the U.S., such as Canada, Mexico, the EU. On the other side, though, we think the tariffs with China will hold. Coming back to prices, I think we're still trading around in a narrow range, and probably we're at the lower end of the range. So it makes sense that prices slightly react to the upside, and we could expect a bit more of that in the coming week.
Now, President Trump has shown his intentions on tariffs when it comes to Canada and Mexico, but there are other sources of oil the US can rely on.
Yeah, indeed. I mean, it's an issue for the US because Canada and Mexico produce and send to the US the same type of oil. Really, it's really heavy, sour type of crude. And there's not too many sources of that type of crude out there remaining. You have the other big one is actually Venezuela, which still ships about 220, 250,000 barrels per day of crude to the US Gulf Coast. And so it makes it hard for the Trump administration, as they're still negotiating with Canada and Mexico, to at the same time go hard on Venezuela. So we have mixed signals when it comes to what the Trump administration is going to be, its stance, on Venezuela. But all these points that, at least in the short term, it makes sense for the Trump administration not to go hard on Venezuela because, the sourcing of heavy sour crude otherwise could become complicated, especially for the U.S. Gulf Coast refiners.
Now, what about a potential peace deal between Russia and Ukraine? Surely that will keep prices in check.
Absolutely. Obviously, the direct impact is a lowering of the geopolitical risk premium on prices. But at the same time, we don't think it's going to be impacting the physical markets whatsoever. We don't think the EU would be ready to go back into buying Russian crude in the short to medium term. And Russian crude production and exports haven't really been impacted in the end by the whole conflict with Ukraine. We've actually seen higher production and higher exports. So when it comes to the physical impact, the impact is going to be very minimal. But you're right, the sentiment is still going to be weighing on prices, and we should still expect at least, I would say, a $2-3 per barrel discount to prices because of that lower risk premium.
Now, this week, you also saw the IEA put out their oil market report, and it believes that Asia will drive 2025 oil demand. Do you agree?
Yeah, absolutely. Despite the fact that our growth number, our estimate is much lower than what the IEA has. For instance, we have crude intake growth this year at about almost even, I think, under 400,000 barrels per day year on year. So very low. But on the products demand side, it's around 750. And you're right, most of that is coming from Asia, overwhelmingly. We have China very weak in terms of crude demand because of overcapacity in the refining sector there. So it's growing at less than 100,000 barrels per day this year. But India is going to be growing quite. I would say not on an absolute term, but on a relative term basis, quite well. Their imports reached a new all-time high last month, about 5 million barrels per day. And the refinery runs are now at 5.5 million barrels per day. But you're right, and when it comes to products demand, it's mainly overwhelmingly coming from Asia.
That was Homayoun Falakshahi from Kpler.